Welcome to the Deep Dive. We're your shortcut to getting, well, really properly informed on topics that can sometimes feel a bit dense. Today, we are diving into Ally Financial. Big player. We're looking at their recent second quarter 2025 performance.
Right.
And we're going straight to the source, their earnings call, their official results. We want to understand what really happened this quarter and, what's potentially next for them.
Exactly. And our mission here really is to cut through the noise. The jargon, the sheer volume of numbers.
Yeah.
We're going to pull out the key insights, maybe some surprising bits, and look at the strategic moves Ally's making in, let's face it, a pretty complex economic environment right now. So whether you're prepping for a meeting or you're just curious about the financial sector, this should give you a really clear, valuable perspective.
Okay, let's kick things off then.
Yeah.
The headline numbers for Q2 2025. Ally delivered, on an adjusted basis, $0.99 in earnings per share.
Right. And that's showing some pretty solid double-digit growth compared to last year.
Yeah, it is. And their core pre-tax income, that hit $418 million. Again, double-digit growth year over year.
Strong numbers.
And if you look at the standard GAAP figures, that's the generally accepted accounting principles, kind of the rule book for reporting financials.
Yes, the standard way, yeah.
Their EPS was $1.04. And core return on tangible common equity, ROTCE, came in at 13.6%. Pretty impressive stuff. What really jumps out at you from those first figures?
Well, look, the numbers themselves are strong, definitely. But what I find really fascinating is the commentary from the CEO, Michael Rhodes. He said he was encouraged and energized, and he put it down to, quote, sound strategic positioning and disciplined execution. Now, here's where it gets really interesting for me.
Okay.
Their net interest margin, or YIN, basically how much they make on lending versus pay on deposits, it expanded by 10 basis points. That's excluding something called core OID, which is a technical accounting thing on debt, not really core operations.
Right, got it.
But crucially, that 10 basis point expansion more than canceled out a 20 basis point drag they got from selling their credit card business.
Wow. So they grew the core profitability enough to completely absorb losing that chunk of business.
Exactly. To me, that shows some serious strategic focus and real strength in their remaining core areas. It's strategic resilience, you could call it.
That is a powerful point. And the CEO really hammered home 3 key takeaways, didn't he?
He did.
First, that this sharp strategic focus is genuinely making Ally stronger, more profitable. Second, the brand itself, the Ally brand, is connecting well with customers, building loyalty.
Right. Resonance.
And third, that their customer-centric culture is a real differentiator. Now, from your perspective, do the numbers actually back that up? Or is it just, typical CEO messaging?
No, I think they really do. I mean, when you dig into the details, you see it. It's not just talk. You see it in where the capital's going, how they're managing risk, the steady customer growth. It feels like they're actually executing on those pillars.
Okay, so how exactly are they pulling off these strong results? Let's peel back the layers a bit, starting with their biggest engine, auto finance. That's under Dealer Financial Services.
Right, Dealer Financial Services. So their auto lending arm generated $11.0 billion in consumer auto originations. That's a big number.
Dude.
But what's really striking is how they got there. A record 3.9 million applications. That's the highest number they've ever seen in a quarter, and it's the second quarter in a row they've hit a record.
Wow.
It just screams strength in their dealer relationships. It cements them as, the top bank auto lender out there.
And it's not just throwing loans out the door, right? It's about the quality, too, the profitability.
Precisely. They got an originated yield of 9.82% on their new fixed-rate retail auto loans.
That's quite high.
It is, and they're funding that with core deposits costing less than 4%. That's a healthy spread. And what really stands out is the credit quality. 42% of those new loans were in their highest credit tier, the S tier.
And that's consistent, isn't it?
9th quarter in a row, they've been over 40% S tier. It shows real discipline focusing on those higher quality borrowers.
Yeah, the consistency tells a story about risk management.
It absolutely does. They seem to have this ability to tweak pricing and their risk appetite pretty dynamically, gives them flexibility as the market shifts. They're guiding annual losses for the auto book between 1.6% and 1.8%.
Okay.
And don't forget the fee income. They get good revenue from adjacent services like pass-through and smart auction. It all contributes.
Okay, so auto is clearly firing on all cylinders.
Yeah.
Let's switch gears to their insurance business. They talk about natural auto-related synergies there.
Yeah, it makes sense, right? If you finance the car, maybe you offer insurance too. It leads to, as they say, robust written premium growth, and they make money investing those premiums.
And the scale is quite significant.
It's actually kind of surprising. Their average dealer inventory exposure, so the value of cars on dealer lots, they ensure that jumped 23% year over year. It's up to $48 billion. And they now have 3.9 million active policies. That's over 1 million more than when they went public. They're supporting 7,000 dealers across the U.S. and Canada. It's a serious operation.
Now, we should address the fact that insurance actually posted a small core pre-tax loss in Q2, $2 million.
Right. Important context there, though.
Yeah, explain that. It wasn't like a fundamental problem.
No, not really. They said it was mostly because of higher reinsurance costs.
Yeah.
Basically, as the business grew bigger, they bought more protection, more reinsurance, and that costs money. If you strip that out, the actual written premiums still grew 6% year over year, so the underlying business is still growing.
Okay, that makes sense. Good clarification. What about corporate finance?
Corporate finance. That segment had a really outstanding quarter, generated a 31% return on equity, ROE.
31%. That's huge.
It's very strong. A lot of that comes from attractive floating rate loans, which do well in certain rate environments, plus healthy fees from arranging loans for others, syndications. It shows they can make good returns across different parts of the credit cycle. Seems like experienced leadership and, again, disciplined underwriting.
And speaking of discipline, the risk profile there looked exceptionally clean.
Yeah, really solid. The portfolio finished Q2 with 0 new non-performing loans, no new specific reserves needed.
Impressive.
And the metrics they use for potential trouble spots, criticized assets, non-accrual loans, they're near historic lows. Around 10% and 1% respectively. It just signals a very well-managed book, especially given, the broader economic uncertainty.
Absolutely. Minimizes surprises. Okay, so beyond lending, their digital bank, Ally Bank, that seems like a cornerstone of their whole strategy.
Oh, absolutely. Ally Bank is the nation's largest all-digital bank. They just hit an all-time high, 3.4 million customers.
And the growth streak continues.
Get this, 65 consecutive quarters of net customer growth. 65.
That's incredible. Over 16 years.
It is, and especially with younger folks flocking to digital, it really makes you ask, right, what does this mean for the future of banking? Is Ally showing that a purely digital model can actually beat traditional banks at acquiring and keeping customers? It certainly feels like a big shift in what consumers want.
And it's not just about customer numbers. It's the stability they bring, isn't it?
Totally. Ally Bank holds $143 billion in deposits. And listen to this, 92% of that is FDIC insured.
Wow. Very sticky.
Yeah, and deposits make up nearly 90% of their total funding. That's a really solid, stable foundation. And here's something powerful. Their Refer a Friend program brought in 15% of their new deposit clients this quarter.
15% just from referrals?
Yeah.
What does that say about customer loyalty? So many banks struggle to grow organically like that.
It says people genuinely like the product, the experience, enough to recommend it. They're not just customers, they're turning into advocates. And tying back to the future of banking, 0.75% of their new customers in Q2 were millennials or younger.
75%.
Yeah. That shows they are absolutely nailing it with those crucial younger demographics. That bodes very well for their future growth.
Okay, so we've seen the engines are running well. But how are they managing the sort of core financial levers? Profitability, capital, especially now. Let's circle back to that net interest margin, NIM.
Right, that NIM.
We mentioned 3.45% ex-core OID, and you said it expanded because they're strategically remixing the balance sheet.
Exactly. They're consciously shifting capital, moving out of lower yielding stuff like mortgages and some securities and into those higher yielding retail auto loans we talked about and corporate finance assets. And the key is it's all funded by those stable, relatively low cost deposits from Ally Bank.
So is this NIM expansion sustainable?
Well, they acknowledge some drivers in Q2 were sort of one-offs, like repositioning securities, but they do expect NIM to keep expanding, although maybe a bit slower, primarily from repricing savings accounts and CDs. And what's really insightful here is their confidence. They actually lowered the rate on their liquid savings accounts by another 10 basis points in late June. That was before any expected Fed action.
So they're leading the market down almost, testing their pricing power.
Seems like it. Shows they feel they don't have to chase every last deposit dollar. They also mentioned achieving a 70% cumulative liquid beta since the Fed started easing rates back in late 2024.
Okay, liquid beta. Break that down simply.
Sure. It basically measures how much of the Fed's rate changes they pass through to their depositors on savings type accounts. A 70% beta means they're holding on to a decent chunk of the benefit from falling rates, not passing it all on. Shows effective deposit cost management, which is crucial for profitability.
Got it. Okay, moving to capital strength. How are they looking there?
Really robust is the word they use, and the numbers back it up. Their CET1 ratio, that's Common Equity Tier 1, a key measure of bank capital strength, it stands at 9.9%. That represents over $4 billion in capital above what regulators require as a minimum.
That's a solid cushion. Gives them flexibility.
Definitely. And another measure, the fully phased-in AOCI CET1 was 7.6%. AOCI is accumulated. Other comprehensive income, it captures unrealized gains or losses on some investments.
Right, gives a fuller picture.
Exactly. And that 7.6% was up meaningfully year over year. So a strong capital base that's also improving.
And how do they achieve that? Just strong earnings.
Earnings helped, but it was also disciplined capital management. Remember those sales of non-core businesses? Point-of-sale lending, the credit card portfolio that freed up capital?
Oh, right. Strategic moves paying off on the capital side, too.
Yes. And they also mentioned they plan to keep using something called credit risk transfer transactions, or CRTs, opportunistically later this year.
CRTs, what are those?
Think of it as a way to share some of the credit risk on their loans with investors. It's an efficient way for them to manage their capital. They described it as a mid-single-digit cost of capital, and it helps generate more excess capital.
Which they can then use, too.
Grow those core businesses we talked about, and eventually work towards share repurchases.
Right, share buybacks. They mentioned those are still a key priority. But the timing depends on hitting higher capital levels, better returns, and just consistently generating capital organically.
Makes sense. They need to be comfortable with their capital base before returning more to shareholders, which brings us nicely to the overall credit picture. How's the health of their loan book?
Yeah, that's always a big question for a lender.
So the consolidated net charge-off rate NCO rate was actually pretty encouraging, 110 basis points or 1.1%. That was down quite a bit year over year and quarter over quarter.
And that reflects the credit card sale mainly.
Partly, yes. Getting rid of a card portfolio helped, but also, importantly, their retail auto net charge-offs were lower too.
Okay, so drilling into retail auto specifically.
The NCO rate there was 1.75%. That's down 6 basis points from last year. But here's what felt like a really key positive turning point.
What's that?
Their 30-plus day delinquencies came in at 4.88%. That number marks the first time it's improved year over year since way back in 2021.
Wow. That is significant. A potential leading indicator that things are stabilizing or improving.
Exactly. They see it as reinforcing their more constructive view on where losses might be headed in the near term.
But they're not declaring victory just yet.
No, definitely not. They stress they're remaining disciplined, prudent, still cautious about the macroeconomy, potential for unemployment to tick up, that sort of thing.
Understandable.
Oh, and an interesting side note, they said the usual seasonal patterns in credit losses seem much more muted now compared to before the pandemic, just reflecting how the economy and consumer behavior have kind of shifted.
Interesting observation. Okay, one last piece on the financial management front. Expenses.
Right. Cost discipline. They seem really committed here, talked about rigorous cost discipline. And the proof. Their controllable expenses actually declined for the 7th consecutive quarter.
7 quarters in a row of falling controllable costs. That's impressive consistency.
It really is. But they framed it cleverly. It's not just about slashing costs blindly.
How so?
They called it investing with intention. So while overall controllable costs are down, they are spending strategically in specific areas.
Like where?
Like bolstering the insurance business, strengthening cyber defenses, always critical, building out AI capabilities, and developing new customer solutions. The idea is that these aren't just costs, they're investments meant to drive future revenue and make the customer experience better. Smart way to manage resources, I think.
Yeah, balancing efficiency with growth investment. Makes sense. Okay, so putting it all together, what does this quarter tell us about Ally's path forward? Their first half seemed pretty strong, maybe even better than expected.
Yeah, that was the message. Performance was solid, in line, or better than they thought, and that's reflected in their updated guidance for the rest of the year.
Okay, what do they update?
They're sticking with their full-year NIM guidance, 3.4% to 3.5%, but they now see a path towards the upper half of that range, so increased confidence there.
Good sign.
And on the retail auto credit side, they narrowed the net charge-off guidance slightly downwards to 2.0% to 2.15%. Again, signaling more confidence in how the portfolio is behaving near term.
Right.
One slight headwind, maybe they expect average earning assets to actually shrink a bit, maybe around 2% year over year. Part of that is lower balances in their commercial floor plan business, which finances dealer inventories. That's influenced by some broader auto industry trends and tariff impacts.
Okay. But overall, the CEO's message seemed pretty bullish.
Very much so. The takeaway was our focus strategy is working. The moves we made to boost returns and cut risk have really strengthened the company. He basically said they believe they're in the strongest strategic position they've ever been in as a public company.
That's a confident statement. So wrapping this up, this deep dive really highlights how a big financial institution can, navigate these tricky market conditions. Seems like focus, discipline, smart capital management are key.
Absolutely. If you connect it to the bigger picture, Ally's story this quarter is almost a case study in strategic clarity, isn't it? They deliberately sold off things like credit cards to really focus on auto and corporate finance, where they see better returns,
Right.
while at the same time just relentlessly managing costs and risk, being able to grow key areas, improve credit, expand margins when the economy is, well, complicated. That's
Yeah.
impressive. It really shows how that kind of operational excellence can set a company apart, even in a tough competitive industry.
So for you, the listener, maybe the final thought to chew on from all this,
Yeah.
Ally's success seems really tied to that digital bank platform,
Yeah.
right? Especially how they're attracting and keeping younger customers.
Definitely a core strength.
So the question is, given Ally's success here, how might the more traditional banks, the ones with branches on every corner, need to fundamentally rethink things? Not just adding an app, but maybe their whole business model, how they engage customers, to actually resonate with that next generation. What does Ally's path really mean for the future of financial services as digital first just becomes, well, the norm? Something to think about.